The Rebel Capitalist Show.
How or does it matter who is buying the treasuries that Janet Yellen is issuing for the government to run those deficits in the first place? Because the way I think about it, if let's say the average Joe buys the $1 billion at the Treasury auction, the $1 billion worth of treasuries, he is swapping the dollars on his balance sheet for those treasuries that Janet Yellen is taking and then just giving to the average Jane, let's say, and she is putting those dollars on her balance sheet. So the net amount of dollars has not changed because they just basically took those dollars out of the system and then put them right back in. Whereas if a banking entity bought the treasuries, then they're most likely using bank reserves. And then when Janet Yellen spends the $1 billion into the economy, now on net balance, we have an increase of the dollars on the balance sheet chasing those goods and services. So does that matter? And if it does, how do you work that into your model?
So that is a very good point, and it does matter to a certain extent. So the most bullish case for inflation and growth is where the Treasury Department makes a hole in their balance sheet. They send resources to the private sector. We have this accounting gimmick nowadays where we issue treasuries. But let's take to fund this deficit. But let's take a step back. When the government makes a hole in their balance sheet, we just said that the private sector, non-financial private sector, bank deposits go up. Okay, whose liabilities are these increased bank deposits, George? They are the liabilities of the banking sector.
Right.
Banking sector liability side has grown. What has grown on the asset side of the bank balance sheet? It's bank reserves. That's basically the accounting identity. They will have more bank reserves. So what happens in most cases is that these treasuries will get absorbed by the banks themselves, because by regulation, the regulators have forced banks to own about 15% of their balance sheet in liquid assets, as they're called, and they have made eligible, of course, treasuries as a very liquid asset, and bank reserves are also liquid assets. So treasuries, banks always have a choice whether to own reserves or treasuries, or some corporate bonds as well are even considered liquid assets. So banks will always have an incentive, as long as there is a reward for these treasuries that have been issued out there, to use the reserves, as you just said, and turn them into treasuries. They will always have this incentive to do so. There will also be other regulatory buyers, pension funds, et cetera, et cetera.
Yeah, so if the banks are buying from the non-bank entities, and that's increasing the dollar assets of the average Jane or Joe.
Exactly.
And then that's creating the dollar. Okay. Yeah.
And basically, because of this regulatory-driven incentive scheme, and because every time the Treasury does a deficit, it also increases the reserves in the system, because if it increases the deposits, then it also increases the reserves in the system by accounting identity. And because of the regulatory pressure on banks, pension funds, asset managers to buy bonds, in most cases, those newly issued bonds are going to be absorbed by the private sector itself. If they are not, by the financial sector itself.
Right.
If they're not absorbed by them, then it's you and I that have to buy treasuries, right? And in that case, you're right that we're basically swapping a newly created deposit into a treasury, which basically means we can't spend that into a CPI item in the basket that is in the CPI, which makes this newly created deposit less likely to bring inflationary pressures. Don't forget, though, that even if we bought treasuries, in principle, we could always try to pledge them against something else. You can always pledge your portfolio, even as a private citizen, to get a loan out of it. So here we go into the more weeds of rehypothecation, et cetera, et cetera. But generally speaking, you're right. If the private sector has to absorb that as private citizens, then the impact is much more sterilized than it is if the financial sector absorbs that, which happens to be the case in most times anyway.
Yeah, it's a fascinating process. Trying to go, I love going through the step by step, what happens first, what happens next. I'm going to try to do that just quickly here to make sure that everyone is following what we're saying, or do my best to articulate this without a whiteboard. So what happens is Janet Yellen has the TGA, which is the Treasury General Account, and that's at the Fed. So that's a liability of the Federal Reserve. That's basically her checking account.
Yeah.
And these banks have these bank reserves, which are the assets that match up their liabilities, which are the average Joe and Jane asset, those dollars that you have in your Wells Fargo account or something. So she issues the $1 billion. The average Joe buys that, and what happens is his his assets are, well, his dollar assets are reduced by $1 billion. Therefore, the liability of the commercial bank that he works with, those are reduced by $1 billion. But they have to send those $1 billion worth of assets, the bank, somewhere, so they send them into the TGA. So now Janet Yellen has those bank reserves, and then when she spends the money, then it goes back into the reserve accounts of the banks for the average Joe, whoever received the checks, and then their liabilities go up as well. Now, what happens also is if the banks need to buy treasuries, and they could buy those treasuries from the average Joe that bought them in the first place, and then by swapping those treasuries for newly created dollars, the amount of dollars in the real economy would increase as well. So I think I did an absolutely horrible job of, I know you understood what I said, but I don't think anyone else did. So I'll have to make sure that next week I turn that into a whiteboard video, because I think everyone would get a kick out of it.
The latest whiteboard you did on bank deposits and bank reserves and bank deposits held by financial sector, the private sector, was just awesome. So if you do one where you start from fiscal deficits, I think that helps people a lot to understand how that works too. It's important because people always assume that fiscal deficits are crowding out the private sector, but in most cases, fiscal deficits are just a net transfer of wealth to the private sector, because the financial sector, by a lot of these accounting tricks you were talking about, basically absorbs the issuance, or is strongly incentivized to absorb the treasury issuance, which leaves the private sector immune from this, and it just basically sends them more net wealth on their bank account. It's important for people to know that. So watch out for the next whiteboard video.
Yeah, yeah, exactly. So I've been trying to think about inflation. You know what? Before I get there, let me get your thoughts on kind of the numbers that just came out. Number one, productivity, I just saw yesterday, went down for Q1 by something to the effect of like 7.5%. So although we may be up for the year, for this quarter, we had our lowest decline, or our biggest decline in productivity since 1947. Just going back to your earlier point. And then the labor force participation, I don't know that it's at an all-time low, but it's definitely going lower. That's one of the reasons why the unemployment rate is at, whatever it is, 3.6 or something like that. People get all excited, the talking heads on CNBC, that the unemployment rate is 3.6%. But if labor force participation is going down, then we're being far less productive. And I think you see that in the productivity numbers, and also the trade deficit numbers. We're producing a lot less stuff, therefore we've got to import more. And the thought experiment I use for people there, let's just say we had 350 million people in the United States, and there was only one person in the labor force, and they were working. Well, we'd have zero unemployment, but yet how productive would our economy be? We wouldn't be producing a lot.
That's pretty much.
So, but we got a great unemployment rate, So, and then I'd like to get your thought on that. And then also today, just about an hour ago, or maybe a couple hours ago, the CPI came out, and we go from 8.5 down to 8.2. So I'd love to hear your thoughts on all of the recent data.
Let's start from the inflation print first. I think a lot of people are looking at the wrong side here. So year-on-year numbers are obviously skewed by base effects. So all complicated, but what it means is that you're comparing yourself to April 2021, where you had a lot of rise in a lot of these base items in the CPI basket. So you had, I don't know, energy going to the roof on a year-on-year basis, or whatever other components are very, very skewed by these base effects. And it's Powell himself who told you in the last press conference that he's focusing more on month, because it obviously is less skewed as a metric. You just measure against last month, and therefore things are much more nuanced there. And so if you look at the inflation print, George, the month-on-month core services inflation is actually the highest it has been, well, in a while. It's like 0.6% month-on-month. core services, which means X energy, it's only the service sector, X the volatile side of the service sector, which basically it's shelter. I mean, shelter and owner equivalent rent and all these measures of housing costs, etc., they have started to move up. On an annualized basis, we're like at 6% there, and it's a large, sticky part of the inflation basket. It's not like you make that measure go down easily. You don't achieve that, which what I'm trying to say is that all the used cars, the vehicles, all the very volatile goods part of the equation is actually coming down a bit, and that's natural. But what's coming up, and people should pay attention to that, is the sticky part of the inflation basket, is the core services part of the inflation basket. And that is a very hard part to bring down. I mean, the Fed really has to make an effort to make sure that goes down. Now, if you look at month-on-month core inflation overall, we have surprised to the upside all the Bloomberg estimates from like 70 economists. Neither of those predicted month-on-month core inflation to be as high as it was. So it is true we have peaked on a year-on-year basis, but that was to be predicted. I mean, geez, if we don't peak on a year-on-year basis, we're already at 8.5%. I mean, where do you want to go? But here, people should focus on two things: the composition of the inflation basket. So it is sticky components or not that are contributing to the inflation. They should look at month-on-month rather than year-on-year. Most importantly, they should look at the pace of deceleration in inflation. There is this concept in finance, which is often misunderstood. The pace of change matters as much as the direction. Now, the Federal Reserve told you they're going to hike to 2 or 3% because they're contingent to inflation slowing down to about 4% by year end. If inflation doesn't slow down to 4%, but it slows down to 5%, the Federal Reserve will have to step up massively in a non-linear fashion to make sure that inflation expectations remain anchored. It's not like if inflation slows, job is done. It's the pace of inflation slowing, it's the component of the inflation basket you should pay attention to. And here in this report, we got the pace of slowing, which was mediocre compared to expectation, was much of a slower slowdown than expected. And also, if you look under the hood, the sticky components of the inflation basket are actually going up and not down, like shelter, for example, which in my opinion makes the Fed pretty nervous. And Biden, he just went to the wires immediately after the inflation report saying the inflation situation is still very serious and I expect the Fed to do their best to achieve the objective to slow it down in a proper way. Now, what does that mean is that these guys will have to step up, right? So that is my first comment on the inflation figures. And the second on the unemployment rate, you're perfectly right. Like, people look at unemployment rate and they forget that it basically ignores, or actually the labor force participation rate drop helps unemployment rate to be visually lower, right? But if you look at the broader measure of unemployment rate, like U6 rather than U3, you start including marginally disattached people, part-time workers, not because they like to work part-time, but because they don't have an alternative, and all this broader definition of unemployment, you start seeing in the last report that it actually ticked up for the first time in a while. So it's the participation rate going down is a big damage structurally to the economy because, as you said, you send a bunch of potentially active workers. They could belong to the labor force. They actively choose not to belong to the labor force. They retire. They don't actively contribute to our economic output, which is not a great thing, I would say.